Alright guys, welcome back. I hope you're all well. So in today's lesson, I'm going to touch on a little bit about journaling and talk about how we trade in a consolidated market. These are two questions that I've been asked quite a lot recently, so I thought I'd do a short video to give you some examples and my thoughts on journaling and obviously trading in consolidated markets. First, I want to start by going through this week's economic calendar. So obviously we're in June, and this is the first week of June. So first week of any month, if you notice here on Friday, we have non-farm payroll. Quite a lot of heavy hitters this week, so you want to trade with caution. Protocol for non-farm payroll week is we do not want to add any more positions by Wednesday New York session. We also have ISM services PMI here on Wednesday, monetary policy statements and ECB press conference on Thursday. The beginning of the month, because of the volatility that we have, if I am day trading, then I will opt to trade Monday, Tuesday, Wednesday. Any other week, I don't trade Monday. The first week of every month, I'm always expecting some sort of consolidation earlier on in the week or the previous week. Now, we've obviously had a lot of stuff in terms of news over the weekend with Trump, and obviously we're in an election year, and we're obviously in a longer term consolidation of the dollar index. So I expect quite a lot of volatility going into the election month. Now, generally, volatility will cause manipulation. But prior to manipulation, we're always going to get some form of consolidation where they're going to engineer liquidity in the markets. Without liquidity, nothing moves. You want to use the economic calendar as a roadmap. So it is one of the most important things when it comes to trading, because this gives you the schedule. Depending on the week and the news events during that week is going to dictate the market profile for that week. We're going to do a lot of studies on this going forward, but I'm just introducing it here. If you are new to trading and you haven't got a lot of experience, my advice is miss the first trading week of every month, especially in the current climate that we're in. Just observe it and journal, right? And that brings me on to the next topic. This is inspired really by one of my students, one of my private students. He sent me some screenshots of his journaling and I was actually really impressed with it. And I've had a lot of people over the years ask me about how do you journal effectively and why is it so important? And I thought I'd share it here with you guys because it's, in my opinion, I think the best way to really understand ICT concepts is to go through previous price action and journal everything that you can see. There's a few examples here that I want to share with you guys. Number one, I like how he's put as much information as he can on the charts, which is relevant to what he can see in price, right? Because you're going to have to get to a level where you're confident in yourself. It's obviously one thing listening to somebody talk about price like I'm doing with you guys. And obviously this particular individual has been through my private mentorship as well, and he's really taken it seriously. Recently with dealing range theory and what I've been discussing on this YouTube channel, you can see how he's incorporated that into his observations when he's going back through price and he's back testing what he can see at the 25 level or the 50 level and the 75 level. And what he is noticing at specific price points on specific dates, and how he's dissecting PD arrays and how price is reacting off specific levels. All of this is going to train his eyes to see these repeating signatures in price. The more he does this, the more he's going to get confident in how price delivers. The more he's going to be confident in knowing when a fair value gap is going to hold, which order block is going to be a high probability order block. And the more you backtest like this, the more you journal, the more you document your observations, the better and better you're going to get. If you're looking at more of the lower time frames, then note what time the highs and lows were formed, note what high or medium impact news event was taking place for that day and at what time, and then write your observations down prior to that news release and after that news release. Where did price go? Was there some form of manipulation? Why did price move to that specific level? And when you ask yourself these things in your journal or as you're backtesting, the more you do this, the easier it gets. Unfortunately, there is no shortcut, because I tried doing a shortcut for years. I hindered my growth because I was stubborn. I thought I didn't need to do this, I'll be the exception, and I wasn't, right? It's only when I started to really document things, when I started to really backtest and journal and write my observations, is when it started to stick. The key here is just to be consistent with it. The money is going to come as a byproduct of doing this. If you learn this skill very, very well, once you apply risk management and you understand trade psychology with this skill set, it's extremely powerful. Yes, it may take you longer than you anticipated. In fact, it is going to take you longer than you anticipated. But don't put pressure on it. Just be consistent, show up every day and write down what you can see in price. Eventually things will just jump off the charts and your eyes will go directly to where they need to go. You won't be in a rush. You'll be waiting for the highest quality setups because you've seen these signatures in price hundreds and thousands of times. And as you're journaling, as you're writing your observations, as you're backtesting, every time you write this, it's being stored deeper into your long-term memory. And this is the part that people don't want to do. This is the part why people fail. If you want to be successful in this, you have to take it like it's a business, and journaling and backtesting is a part of that business. Collecting this data is a part of that business. Being accountable and showing up every day is a part of being professional and being a professional trader. You're a professional, right? Pressing buy or sell just to see what happens is not trading. And until you get yourself out of that cycle, you're never going to be able to get this. Unfortunately, most of the industry just does that. Buy my system, here's my Lamborghini lifestyle, that's all rented. But they won't give you the true nuts and bolts of what it actually takes to become successful as a trader. Telling you that this is going to take you time and it's not going to be easy is the reality of trading. You have to allocate time in the day to do stuff like this. You have to drill this into you that I have to, if I want to be a trader and I want to make money in these markets, I have to, as a part of my routine, as a part of my lifestyle, allocate some time in the day to do this. Those who say ICT concepts don't work and he's a fraud and there is no algorithm is because they've never actually sat down and done stuff like this. So I just wanted to share this. I thought it was a really good example. You don't need to write pages and pages and pages. Look for the salient points and note them down. It shouldn't take you more than half an hour every day to go through the previous day, the previous week's price action and just note your observations. And just doing that alone will give you so much of a clearer understanding. Like, really don't underestimate how powerful doing this is, right? Anyway, let's get into the charts. So here we have the dollar index on the daily time frame. Now this is pretty much the same chart from where we left off last week. We've been really consolidating in this area. We are in a longer term consolidation, and I highlighted this on the weekly time frame in the previous mentorship lecture. Now, when we are in a higher time frame consolidation, the lower time frames are going to reflect what the higher time frames are doing, right? Price is going to move choppier, it's not going to be as clean, and you're going to get a lot more consolidation. Price is going to stay inside of dealing ranges for longer periods of time. When the higher time frame is moving in a direction and it's trending, the lower time frames are so much easier to trade. That's when you see all your PD arrays in price being supported, and that's when you have your nice low resistance liquidity runs. That is not to say that that can't happen on a lower time frame inside of a higher time frame consolidation, because obviously you're going to get price swings and some pockets of clean price action. How do you trade consolidated markets? we have already established that we have this dealing range where we have our major buy side above these highs and we have our major sell side down here. So this is our dealing range high and our dealing range low. All of this price action is inside of our dealing range. Now we could stay in a longer term consolidation. Really, this is building engineered liquidity in the market. It's manipulated, right? So all of this price action is staying inside of this dealing range from this high down to this low. Now, I've touched on this in the first episode with the introduction to the dealing range theory. And essentially, we have seen price run from this low all the way into our extreme premium, which is our highest quadrant. Inside of the extreme premium, we have come into the equilibrium price point and we've rejected from this liquidity void. Now, when we have consolidated markets, we move from extreme premium to extreme discount and back to equilibrium. Inside of this extreme discount, we have this buy side imbalance, or the remainder of this buy side imbalance, from this candle's low to this candle's high. Notice the consequent encroachment overlaps perfectly with the equilibrium of that lower extreme discount quadrant. We also have the retail trend line that I spoke about in last week's video. There's a whole lot of sell side liquidity resting below this trend line. We're currently inside of this fair value gap. This is a sell side imbalance. We had sell side delivery here, and then we had buy side delivery back through that range. Now, the consequent encroachment of this sell side imbalance rests over here, and we're having a hard time to close back above it, as well as the three levels that I identified last week. We also have this buy side imbalance that has been rebalanced here. Again, look at the bodies. Now, inside of a balanced price range is where we're going to find consolidation, choppy price action, and generally we will see high resistance liquidity run conditions. I don't want to trade inside of here. The market here isn't showing any signs that it wants to run higher. The fact that we're not closing above this high, you can see the bodies are really respecting it, indicates weakness to me. If I were making these markets, I would run it lower to upset the retail trend line, rebalance, and then take it higher to run the equal highs up here, and into that weekly sell side imbalance. If we run buy side first, then I would anticipate a run on sell side after. That will be the manipulation to take us higher. If we run sell side first, then I would be looking for buy side after. So the manipulation to the sell side was to upset retail sentiment, right? That's how I prefer to see it be played out. Now, if I move over to the euro dollar and the pound dollar, this is again on the daily time frame. You can see how we have our dealing range high and our dealing range low with our DRT levels plotted on each one. I want to bring your attention to this sell side imbalance, which we have traveled through to become an inverse fair value gap, and the consequent encroachment is being respected really nicely by the bodies over here. We've wicked into the equilibrium level, and then price is rejected and moved higher. I like how we've wicked back through the opening price of this down close candle. Here on the British pound, you can see how we have this small sell side imbalance that also becomes an inverse fair value gap, and that's offering support over here. We also have this up close candle as a bullish breaker. You can see how we're expecting the mean threshold there really nicely. I'm also noting the fact that we've made a lower low here on the euro at a support level, and we failed to go lower on the British pound. We have relative equal highs above us here, so I want to see that run through. Ideally, I would like it to stay firm here. I want to see this measuring gap left open and make a run for these highs up here. We have a whole lot of buy side liquidity above these relative equal highs on the euro, and then we have all these equal bodies up here. So again, there's going to be a pool of buy side liquidity resting above that. So if we do see a drop on the dollar index, then that's going to send the euro and the pound higher. I also like how we have these lower highs, and this is known as a low resistance liquidity run signature, right? This provides an opportunity for the market to run through this area with much greater ease than if we have higher highs. Whenever I'm looking at price runs, I'm always looking for this signature. I want to take your attention back to the dollar index on the daily time frame, and I want to bring your attention to this volume imbalance that we outlined last week, right? So we have these consecutive up close candles as an order block, and we have this volume imbalance in the discount end of this bearish order block. You can see how the bodies here are respecting that. This is what it looks like on the 4-hour time frame. We came into it once over here, and we came into it, and look at again the bodies respecting the premium end of that volume imbalance. Now, where's the dealing range here? We've run this high over here, and we ran this low over here. So the dealing range is going to go from this high down to this low, and then we can grade our DRT levels. I keep doing this the wrong way around, I do apologize. This should be the 75 DRT level. So the 75 DRT level overlaps beautifully with the consequent encroachment of that volume imbalance. Also note where we have our gaps forming. Right, I've done a number of examples on gaps and where they form throughout this mentorship already. But here's again another really nice example. We have buy side liquidity above these relative equal highs over here. And you can see how we've ran above that here, but the body's again telling the story that it doesn't want to close above that volume imbalance inside of that daily order block. Just coming shy of completely closing in this sell side imbalance. Now again, that's very typical when we are in a consolidation / seek and destroy profile. If you look, we've just run highs and run lows and run highs and run lows, and then always coming back to the midpoint of the range. This here is occurring inside of an extreme premium, and price will stay between these two levels. Inside of the extreme discount, you can see how we swept below these relative equal lows, but again, we've just come short of fully rebalancing this buy side imbalance. Now, this is a signature I see all the time inside a seek and destroy or consolidated markets. You don't want to trade inside of this region. You want to look for buys inside of an extreme discount, which has swept liquidity in the form of sell side liquidity, and you want to only take shorts inside of an extreme premium once we've run liquidity and or dipped into a fair value gap. This is another beautiful example of dealing range theory and how these levels are structural support and resistance, and how price will move from extreme premium to extreme discount. So I hope you guys have found this one insightful, and I will hopefully catch you again in next week's episode. Thanks for watching, and take care, guys.